30. I'm just going to wait a few minutes here, get started. People are still connecting. Okay. Well, good afternoon, everyone. My name is Joe Demore. I'm calling you from Boston, Massachusetts. I've been shoveling since Saturday morning. I got done 10 minutes ago. So I welcome this opportunity to spend some quality time with you. Before I transition to our guest, I wanted to go right over to Emily, our colleague, so that she can give us a little bit of information on the March talk that we're having. Go ahead, Emily.
Hi, everybody. My name is Emily Chan, co-host of Knowledge Circle. On March 12, 2024, Tuesday, same time, 3 p.m. Eastern Time, I'll be hosting Margarita Chan as a guest speaker. And the topic will be personal branding and content marketing. And what she will do is to tell to share with everyone how to tell your unique story while marketing your services. Thank you.
All right. Thank you, Emily, and welcome again, everyone. I'm really excited to introduce my colleague, Josh Bloom. I can tell you over the years, whether I've heard it from colleagues, investment advisors, insurance planners, and certainly clients, people have asked or inquired to me about reverse mortgages, and it's intentionally been an area that I've avoided. I've learned that it's a highly specialized area. It's not anything that I would feel comfortable practicing in, and certainly I work really hard. I think all of us do, in staying up to date with with information, but I never had that comfort level with it. And it's also very complicated. I mean, for example, even where interest rates are can have an impact to a client, in terms of what's available to them in terms of the different types of reverse programs. So I'm excited to introduce Josh Bloom. Josh is a specialist in this area, but he's also really passionate about this area. And probably the most important thing that he won't say and you won't read on his website, how deeply he cares about my clients. And that's the kind of person that's in my constellation of stars, if you will, of people that support me on the periphery in areas that I do not practice in. Josh is that star in my practice. So I won't tell you any more about his story. I'll let him tell his story. And Josh, you're on.
Joe, thank you very much. And thank you everybody for joining us today. I'm going to go ahead and share my screen. Joe, if you could, can you just confirm when I do that you're able to see this?
Yep, looks great.
Okay. Thank you, Alvin. So big thank you, Joe, for having me on as a speaker. Alvin, Emily, thank you for including me in this series that you've got throughout the year. And Nick, I appreciate the coordination. Also, special thanks. I see some of my FPA and Miami folks in the crowd. Thank you for joining us today. I appreciate it. Like Joe said, my name is Josh Blum. I'm a specialist in the reverse mortgage. I am a certified reverse mortgage professional. I'm one of a few hundred in the country. I'm licensed in 17 states. I've been working in the retirement income space for about almost 20 years now. The last 6 years or so, I've been specializing in the reverse mortgage and nothing else. I am an author on the subject. I wrote the Consumer Guide to Reverse Mortgages. It's available on Kindle. I'm also happy to send a hard copy to anybody who has interest on the call today. Afterwards, great resource, nuts and bolts, A through Z, on what the reverse mortgage is, who it's effective for, why people should consider it, and just some basic case studies that people can look into. So excited to be able to offer that to anybody who's on the call today and has interest. We're going to talk today, and it's a CE presentation. We're going to talk for about 50 minutes or so on this subject, in particular, women vulnerable in retirement, housing wealth solutions. The presentation itself is north of 60 slides. There's no way I can get through 60 slides in 50 minutes. I'm not going to try to. What I am going to do is I'm going to touch on what I think are the most important aspects of women in retirement, transitions we're seeing, 50,000 foot view in the financial advisory industry, why housing should be a solution that we integrate into planning today, and then how the reverse mortgage specifically can fit in and certain scenarios where it just makes a whole lot of sense. We're going to be looking at information that's evidence-based and empirical. A lot of the case studies later on that you'll see will have data from Money Guide Pro, where this has been entered into the financial plan itself, where information from retirement researcher Wade Fowles website, a whole lot of intention behind what we're going to look at today, and it's not something that's guesswork or conjecture. We know this can have an outsized impact on securing retirement for a lot of people, especially women. So without further ado, I'm going to jump into it. Joe's going to be handling the chat. So if there are any questions that pop up, if I'm moving through something so quickly, raise your hand, make a comment. Joe will alert me. I'll carve out time for questions throughout the presentation, unless they seem like they're going to run too long, in which case I'll probably defer them or kick them off outside of this conversation, if that's okay. All right. Thank you. All right, let's dive into it. I know we're talking about vulnerability with women in retirement, but I don't think we should have this conversation without addressing the shift in the industry and the marketplace today. There is a massive wealth transfer that's expected. McKinsey did a study, and it's expected by 2030, we're going to see up to $30 trillion of wealth transfer over to women. That expectation is partly because we'll have parents passing on wealth to their children, but also because women will outlive their husbands, and their husbands will transfer wealth over to the woman. This is probably the greatest shift in wealth we've ever seen in this country over a short period of time. And it's going to really change the landscape of how advisors like yourselves work with your clients and who you work with. And it's amazing because it offers this unbelievable opportunity for advisors. It offers a tremendous chance for you to really define how you're going to serve your clients in the future. It also presents a tremendous risk, because although a lot of this wealth is transferring to women, it doesn't necessarily mean that women feel especially strong or positive towards their advisory relationship today. The trend as it stands already is that women, if they do outlive their husband, are likely to take their assets and leave their existing advisor relationship, which is suggestive of one thing, that the relationship really isn't there in the first place. The truth is, for a lot of women, they just don't feel heard. They do not feel like they are a part of that relationship. They feel like they're a third wheel. If they have a question, they feel like they're patronized. And unfortunately, they're already coming from a scenario where traditionally they have a little bit less financial knowledge, or they have a little less control over the finances themselves. They deferred that to somebody else in their relationship. And so there's I think an underlying need we need to identify as advisors here, that as we work through this presentation, as we look through the vulnerabilities that women have in retirement, we need to think about how we can take this information and how we can redefine and better engage with our relationships with women moving forward. It's important to the industry, and it's important to our business model to be able to change this and change how women look at their relationship with their advisors today. I'm going to try to take some moments from time to time just to illustrate where I think there's some opportunities to do so, or some deeper conversations to be had that will facilitate that for you as an advisor. And hopefully, just from an action item, you'll be able to take some of that right away and utilize it as you're meeting with clients going forward. So let's look at the first major vulnerability, and what I consider the fundamental vulnerability that attacks women's financial security in retirement, and it's longevity. We all know about longevity. We all know that people are living longer life expectancies. It's what we call in the industry the great multiplier. Longevity multiplies all of our other risks. So when we look at retirement and distribution planning, we recognize that, okay, we've got to worry about things like running out of money and sequence of return risk. We need to worry about rising healthcare costs, inflation, cost of living, taxation. There's a whole number of risks that really increase given the time horizon of our retirement. And so it becomes a fundamental problem. And well, a major reason there is so much wealth transferring to women is because of longevity. They're simply living longer than men. We see it as early as 65. There's a disproportionate amount of women to men. By the time we get into our 80s, it multiplies and magnifies. And then if you hit 100, you look around, there really are no men at that stage. Women are living for a long time. It is a major vulnerability that impacts them in retirement. And it's the number one concern we should have, and we should be expressing to our clients as we go into the distribution planning phase. It would be a disservice, however, to suggest that the problems and the vulnerabilities that we see women face in retirement start in retirement. They do not. A lot of these challenges begin early on in people's lives or their working lives. And the first vulnerability that I want to highlight here is the pay gap. And when we consider the pay gap, still today, about 80 cents on the dollar, women are earning pound for pound for the same exact job that a man might do. That means they have 20% less purchasing power, assuming that expenses are the same for a man that they are for a woman. And there's really two impacts here to retirement. When we think about this, there are two ways it's going to impact our retirement. Number one, if I'm making 20 cents less on the dollar, then my ability to save is going to be lower. And thus my ability to set money aside to invest and to grow for when I am in retirement is going to be less, and I'm going to have a greater challenge doing so. And so we see that women often end up with less assets to utilize in retirement than men. It's almost a statistical guarantee. So that's the first impact that we have when we have a pay gap vulnerability. It doesn't stop there, though, because I don't think it's going to come as a surprise. If we make less, then we'll receive less when it comes to guaranteed income. And all we're showing here is that pay gap, that 20% pay gap, essentially shows up in Social Security. And when we look at economic instability, and we look at couples, we look at men, and we look at women, it's a glaring difference. There's an absolute glaring difference in the instability that women have in retirement because of this pay gap. So we know we have fixed expenses, we have guaranteed income that's supposed to be a part of Social Security, and yet we're taking a hit because of this pay gap with our guaranteed income. It's harder for us to cover our fixed expenses. Ergo, we end up with greater economic instability as we age. Major, major vulnerability in retirement. So it starts with longevity. Yes, that's the fundamental, but this is really something that's occurring early on in women's careers and even potentially earlier. Being a widow is a major vulnerability for women in retirement too. In the last 6 years, I would argue that 2/3 of my conversations as a reverse mortgage specialist are with widows or adult children whose mother is widowed. And it's prevalent. Women are more likely to be widowed. I want to talk through what it means to be widowed, though, in my experience, because having had 1,000+ conversations over the last few years on this topic, I need to put out there that becoming a widow it's a process. This is not my husband was here one minute and the next minute he was gone. This is my husband was ailing. My husband grew ill. There were health issues that popped up, and I needed to look after my husband before I became a widow. And so there's an impact in becoming a widow that happens even before the actual death or the event of death. And caregiving, to me, has to be one of the greatest vulnerabilities that we see women face in retirement, because it impacts them potentially not once, not twice, but as many as 3 times. And I'll use my wife as one example. I have a 9-year-old son, and when we had our son, my wife decided that she wanted to be a stay-at-home mom. She took 4 years off from work to take care of our son. could certainly say that impacted our ability to save. My wife is an RN, so whatever income that she was receiving from work, she no longer received as she stayed home to raise our son. It also made it much harder for my wife to rejoin the workforce later, even with something in demand like being a nurse. That's one instance where we see many women leave the workforce for caregiving. The second instance often happens because we are in the sandwich generation today, where we have aging parents that we have to take care of. And I've got a scenario I just worked through very recently where a very close friend of mine, let's call her Rosie. Rosie's mom last year was diagnosed with brain cancer, which she was able to overcome. But then about 9 months later, she ended up with pancreatic cancer and was declared terminal. Rosie had a choice, and she chose to take the time while her mom was there to help care for her. Although I'm not sure she had as much choice as I'd like to think, because somebody had to help manage the care. Even though Rosie's mom had long-term care insurance, somebody still had to coordinate everything. Somebody had to be there. And so that's the second instance in where we see caregiving can have a serious impact on somebody's earning ability and somebody's ability to have a secure retirement. And then the third way, of course, is through being widowed and having to be a caregiver as a spouse or a partner is aging or passing away. And so this can have just an absolutely tremendous exponential impact on retirement security. And it's not something that we can ignore. In fact, I would argue as advisors working with women, this is a really powerful conversation to have. Have you been a caregiver? What kind of impact did it have on you emotionally, mentally, financially? Are you prepared for that again? How do you intend to handle it? What did it mean to you? These are the types of questions that can really help women feel validated that what they are sacrificing to become caregivers is appreciated and understood by you as an advisor. It will really help engage in a way that maybe you haven't been able to previously. So in addition to these vulnerabilities, divorce can have an outsized impact on women as well in retirement security. It's not to say that divorce can't impact men as well, but oftentimes it does have an oversized impact for women. Late life divorce today is the number one divorce in this country. You have more people 50 and 60 years old and above that are being divorced and going through divorce than 20 and 30 and 40 year olds. So the number one demographic going through divorce is that silver or gray divorce. When we think about divorce traditionally, we often find a scenario where we have wealth and we have wealth in the home, and we have to split our wealth. And a lot of times it's common for the woman to keep the home. And what that means is the woman may end up with less liquid wealth for retirement and less retirement assets, or potentially none at all. It's especially impactful when we consider that the house a lot of times represents more than 50% of the wealth in a retired couple or a couple 60 and up today. And so later life divorce, another major vulnerability. So to recap already, we've talked about longevity pay gap. We talked about a decrease in Social Security and guaranteed income in retirement. We've taken a look at the impact of widowing, divorce, and being a caretaker. These are just some of the vulnerabilities. I think it goes beyond that, though. When we look at the behavior in financial planning and behavioral finance, which is something I happen to geek out over, by the way, it's very interesting. Women are statistically more risk averse than men when it comes to investment, allocation, risk. They feel the pain of losses more than men do, statistically. This is not opinion. This is the reality. Women tend to be more conservative than men when approached with the same scenarios. The irony here, of course, is if we have to deal with longevity, then it's one of the worst behaviors we can do is lean conservative. We probably should be biased to more aggressive allocations early on in retirement to protect against the longer time horizon that we have. And so behavior becomes an issue too. It's not just macroeconomic factors that are taking hold here and making women vulnerable. It's that the way we react to risk and respond to risk is different as men than it is as women. And so we need to be cognizant of that and aware of that. And this is a conversation we should absolutely be having with couples, making sure that there isn't a difference in the risk tolerance, and making sure that couples especially are honest about this with each other. A lot of times the amount that a couple will actually share with each other is limited. They're protecting each other, they're protecting their feelings. And so we want to make sure that we explore that and we give each individual in a relationship the opportunity to talk about this a little bit more so we can better understand where their real risk tolerance is, but also communicate why we may need to push on that a little bit for the viability of a secure retirement. I'm going to add to this. It's not a slide, but there is absolutely a gap in financial education that we've seen historically between men and women as well. It is traditional for men to have taken the lead on the finances in a household, especially. And so oftentimes married couples, you'll find the woman doesn't have the same financial acumen as men. The knowledge base isn't there, the control isn't there. I have a good friend who opened up a company called Second Vault simply because she nearly died and she realized that she didn't know where her husband didn't know, excuse me, where any of the finances were. Now that situation is reversed, but that scenario where one partner has full control over the finances is very common. And so to have this conversation about education and sharing in the accountability and responsibility is a great way to make sure as advisors we're engaging with both women and men in our conversations. This is the last vulnerability I want to go over, the pink tax. I can't see hands, but as a husband, I've had the chance to shop at Sephora a couple times for my wife. And I can tell you point blank, there is a massive difference in cost for women's self-care that there is for men's self-care. It doesn't just apply to self-care and makeup, though. The reality is women have gone through a pink tax their entire lives, and it starts as young as children and childhood, where we could say the same exact bike helmet, pink versus blue, there's a premium of 2x essentially to buy the pink helmet. And we have 3 or 4 slides on this that I'm not going to go into, but this is a reality. There is a pink tax, and it really comes back to what I brought up earlier. Pound for pound, if we have a 20-cent pay gap between men and women, 80 cents to the dollar for the same work, if the expenses are the same, we're going to have a real challenge growing our assets to the same level, having the same security in retirement. They're not the same. Those expenses are not the same. There's an absolute cost to being a woman in this country, and it exacerbates some of these other vulnerabilities and makes it a real issue. So when we look at this picture, we've got a ton of wealth transferring to women, but we have some serious vulnerability that they're facing, some serious risks to their retirement security that we just don't see in planning for men. And we need to address it as advisors today if we want to be able to take advantage of that great opportunity, that $30 trillion in wealth transfer. But we also need to do it to better serve our clients, period. So whether this is for a personal gain or whether it's for the service of your clients, irrespective, this is an opportunity to do better ongoing and serve both your business and your clients. So I'm going to shift gears for a minute. I want to talk about housing wealth. I'm thankful there's a lot of institutions, especially academic institutions, that have really looked at housing wealth and looked at how it integrates into planning traditionally and maybe how we could become better at integrating that into planning. And you've got here a slide, the University of Illinois, the Academy for Home Equity. You see people up there like Wade Pfau, Jamie Hopkins that you may be familiar with, Barry Sachs. But it's not just the University of Illinois, it's Texas Tech, it's Kansas State, it's John Salter, it's Boston University. There's been tremendous research on integrating and coordinating housing wealth into retirement planning. And the research all points in the same direction. If traditional planning is as simple as we're going to exhaust all other options before we look at the house, then traditional planning is probably wrong. We shouldn't be ignoring the house as an asset. We should be coordinating it as an asset. And that can mean a whole lot of things. It's simply recognizing that we need to take a different look at planning because things have changed over the years. And what was appropriate for planning 30, 40, 70, 90 years ago is maybe no longer appropriate today. And that's really what a lot of these institutions are saying. But there's good validity behind it. First of all, most retirees, they are homeowners. And 4 out of 5 women, by the time they're in their 60s, they are homeowners. So we know it's an asset that most people have. It's not something that's limited to just a few people in here or there. This is an asset that most people have and actually represents a pretty significant amount of money. Now, this slide and the data you're seeing on the slide, it's old, it's stale. If you can see the statistic down there, it's 2011. The data has grown, and the value here on the equity in the house has grown since 2019, 2020, through the last few years. Home equity now represents on average about 68% of the wealth for retirees. So when we look at their overall wealth and we say how much is investable and how much is in the house, about 2/3 of the wealth is in the home, not in investable assets. The housing market represents trillions of dollars of wealth. That's more than all money in 401ks combined. It is a massive, massive market, and it's something that most people have access to. It doesn't mean there's one right way to use housing. Here we have just some examples of what we could consider housing solutions to be. It could be utilizing Airbnb and short-term rentals. It could be the Golden Girls renting to roommates. It could be downsizing or right-sizing. It could mean moving in with family and increasing that nuclear family. It could be getting a traditional mortgage. Or alternatively, it might be a reverse mortgage. Now, for the purpose of the conversation today, I'm not going to focus on the changing of the living environment. I'm not even going to focus on the traditional mortgage. I'm really going to dig into the reverse mortgage and how that as a vehicle can be a really effective tool as a housing solution. And that's what we're going to jump into over the next few slides, and then we'll look at some case studies. But there's no doubt that from an asset perspective, housing is a large percentage of our wealth and not something that should be ignored today. So the reverse mortgage, what is it? I find that people like to overcomplicate this. Even this slide seems really challenging to understand. What is a reverse mortgage? It does not need to be this complicated. It has the word mortgage in the name, and that's exactly what it is. It is a mortgage. There are some key differences between traditional mortgages that we're more familiar with than the reverse mortgage, and yet ultimately it's just a mortgage. The way I describe this to clients, and the way I believe you as an advisor should probably be speaking to clients about this, I would use this language. Do me a favor and imagine you're in your home right now. I'd ask you to just picture your home. Can you see the rooms around you? I want you to walk through your home. And I want you to imagine for a second, you're walking through a room and there's a door in the wall that you didn't know was there before. You never noticed it, but there's a door there. And you go over it to the door and you try to open the door handle and you realize it's locked. A reverse mortgage is like a key to that door. And behind that door is a whole bunch of wealth. We have a lot of money in the walls of our house. If it represents 2/3 of our wealth, we have a lot of money in our home. But we may never have really looked at utilizing that money, and we may not have ever given ourselves access to get that money. The reverse mortgage is essentially the key to unlock the door. It's nothing more. It's giving us access to the money that's already in our home. It doesn't mean we're spending it. It doesn't mean we're doing anything with it. It just means we now have that key and we know the door's there. That's what a reverse mortgage is. Now, that can have a lot of meaning, And there's a lot of ways we can use the money in the wall and behind that door. But the reverse mortgage is just the key to access the wealth in the house. It was not created by lenders. I think this is something that a lot of people have looked at these and they've earned almost a predatory reputation. Some of that has been industry driven, admittedly. But the reverse mortgage was signed into law in 88 by President Reagan. It was put into place by Congress in 87, and it's evolved over time. Chances are every single person on this call right now has a cell phone somewhere within 5 feet of them. And a cell phone is a cell phone is a cell phone, right? Except when it's not. Because cell phones have changed tremendously over time. And so has the reverse mortgage. The difference is we've all replaced our cell phone over the last year, 2 years, 3 years, whatever that time frame has been. Some people are still walking around with reverse mortgages from 20 or 30 years ago. And so the reverse mortgage is an interesting tool in that it has evolved, but for some of us, we're still walking around with something from 20 years ago if we have a reverse mortgage. And so it's almost like the cell phone. Is a phone a phone a phone? Sure, except what a phone can do today isn't what a phone could do 20 years ago. Our phone has much more capabilities today, and arguably the reverse mortgage has much more capabilities as well. You can see that on the slide. Just in 2009, there was the ability to start buying homes and purchasing homes with the reverse mortgage. And then in 2013, you had massive changes to the reverse mortgage to put in consumer protections to make them much more viable long-term planning tools. So the reverse mortgage has changed seriously over time. It also happens to be one of the most regulated loans in the country today. This is one of the only loans that requires actually third-party counseling for somebody to utilize. So if I say, hey, I want to get a reverse mortgage, that's great. That's all well and good. You can't just get a reverse mortgage. There's consumer safeguards in place. And one of those is third-party counseling to make sure that you are looking at your budget, to make sure you do know their alternatives, to make sure there's mental capacity there. There is no coercion from kids, that you have hopefully your best interest in heart, but also a clear understanding of what it is, how it works, and what the rules around it are. And so we have a highly regulated loan that does also require a financial assessment. It used to be, I fog a mirror, I could get a reverse mortgage if I have equity in my house. That is not the case. And it has not been the case for a long time. Now you have to show a capacity and willingness to pay your expenses and have leftover money every single month that shows I can afford my taxes and insurance. I need to also be able to show a willingness and a responsibility of being able to historically have a pattern of paying my bills on time. And so they're looking for people not only with income and enough money to afford to live in their home, but you have to be able to demonstrate some sort of responsibility as well when you apply for the reverse mortgage. So some significant changes to ensure that it's a safeguarded loan, that we're not taking advantage of seniors with this, and that we are utilizing it when and where it's appropriate. With all that said, Joe put it really well when he suggested that a lot of advisors, himself included, might have avoided even having the conversation because it is a nuanced product. It is a very specialized product. The typical loan officer might handle one reverse mortgage a year, maybe. They represent less than 1% of all loans in this country. They are not prevalent and commonly used. Although it's been stated within Wade's book, actually, that there's probably about 10 times greater utilization possible for the reverse mortgage than is actually taken advantage of. And one of the reasons is there's misconceptions, not just from consumers, but from advisors as well. There's a really interesting study done about a decade ago, and it was a 10-question quiz on the reverse mortgage. And before people took the quiz, they were asked a question, hey, what's your confidence level here? Scale of 1 to 10, how confident are you that you understand the reverse mortgage, what it is? 10-question quiz, what are you going to score? 80% of people were highly confident. I'm going to get a 90 or 100 on this thing. The average score was a 30. They're nuanced, and they're a lot more nuanced than people give them credit for. There are so many myths and misconceptions out there as well I think in part because of what I explained before. Just this idea that somebody could have a reverse mortgage from 20 years ago, and is that really the same as a reverse mortgage today? Well, some parts of it certainly are, but some aren't. So some of these myths and misconceptions that are very popular, you give up title to the home, I'm giving up control of the house, is the top thing I hear from people. Number two, I can owe more liability than the home is worth. These are non-recourse lines. That is not the case. You can never pass on liability beyond the value of the home to the beneficiaries. Misconception number three, I'm going to be forced to move at some point. In other words, if I spend the equity available to me, I've got to get out of the house. This is just not the case. And number four, that there's a payment required. A lot of people actually think there's a payment required. And we're still responsible for certain things like our homeowners association dues, taxes, and insurance oftentimes, but we do not have principal and interest payments with the reverse mortgage, which happens to make it such a powerful planning vehicle in retirement. Allows us to utilize money without negatively impacting cash flow. So when we look at this and we're trying to explain it to people, the absolute first question I always get asked is, well, what happens when? Doesn't matter how that question is phrased, it's always in the future, what happens? And again, this is where I think people overcomplicate the reverse mortgage. If I have a mortgage and I die today, tomorrow my heirs they have to figure it out. They've got to work through this. I borrowed money and now I passed away. There's a loan balance that needs to be solved for in some way. So with traditional financing, if I pass away, well, my heirs, they get a choice. Am I going to keep the house? If so, am I refinancing this loan into my name? Maybe, not often, but maybe I can assume the loan. But most of the time, I'm going to have to refinance it into my name. Or I'm going to have to pay off the loan balance. I might need to sell the house if I'm going to do that to pay off the balance, but then I keep the equity. Well, that's the same exact thing that happens with the reverse mortgage, assuming that there's equity to be had. So I have all the same options for the most part that I would have with traditional mortgages with the reverse mortgage. I just have to determine, do I have equity left in the home or not? And to be clear, the reason I'm saying that is if I borrow money and I never make a payment on it, there could come a time where I owe more than the house is worth. I'm not responsible for more than the house is worth, but I might have a dead asset. I might have an asset that's worth zero to me. There's value. The house can be sold, but I have a loan balance that meets or exceeds the value and the sales price. So I'm not going to get any money from that. If the loan balance does exceed the value of the home, and this is where it's non-recourse, HUD has protections in place so that liability does not pass on. FHA insures these loans. The FHA insurance fund, the same exact insurance fund that every first-time home buyer that does FHA financing, by the way, it's the same fund. Everybody pays into that fund. The same with the reverse mortgage. You pay into that fund. That fund covers the gap for lenders and it protects the homeowners. It's the grease that allows the marketplace to work. If homeowners felt like they would be passing on additional liability above and beyond the value of the home, I don't think they would do it if they had any beneficiaries or kids. And lenders certainly wouldn't lend money if they didn't think they were going to get their money back at some point, sooner or later. And so that FHA insurance really is it's an essential piece of the marketplace, and it makes the marketplace go. If the reverse mortgage is a way to access the equity in our homes and access the money in our walls, then it means we have a lot of choice typically in how we're going to take that money. Now, we could take it as a lump sum, and there's plenty of instances where this makes a lot of sense. Let's say I have a lot of credit card debt I have to pay off with very high interest rates. Perhaps I have an existing mortgage payment on my house and a mortgage balance to pay off. By the way, over 50% of people in retirement now do have mortgage debt in retirement. Perhaps I just need greater income because my Social Security benefits are limited. I don't have a lot of outstanding assets. I need a way to supplement my income because I have increasing costs. And we can set up income for as long as somebody lives in the home, no matter how long they live in the home. We can set it up for a period certain, just like we would an annuity. Hey, I need X amount, and this is how many years I'll get it. Or I'll need 10 years worth of income. What can I get based on the equity of my house? I can also create a line of credit where I'm not actually spending the money. I just have access. I have that key in my hand. Or it could be any combination of the above. And when we think about this and we say, okay, reverse mortgage, it's a mortgage, it's borrowed money. I'm not paying taxes on this, it's borrowed money. I have access to what may equate to 40, 50, 60%, maybe more of my total wealth. And I have full flexibility in how I use that money. In other words, we're looking at a non-tax buffer asset. That's essentially what the reverse mortgage creates. And what we can do with that really is limited by our imagination, no different than it would be with any liquidity bucket or cash bucket. Truthfully, this could serve as a cash bucket of its own. Why am I keeping a client's investable assets liquid when I have a pile of cash right here under the roof over their heads that we can utilize as needed? So there is a tremendous amount of opportunity when we have full flexibility to determine this. I'm going to talk just briefly about this line of credit because it operates a little bit differently than traditional home equity lines of credit that most of us are familiar with. With a traditional home equity line of credit, my credit is what it is. You know, if I'm offered $100,000 by the bank and it's an open-ended adjustable rate loan, then that $100,000 sits in a line of credit. I choose when and how to spend it. In both instances, if I spend some money and I pay it back, I should get access back. And that's exactly what you're seeing on this slide. What's interesting about the reverse mortgage line of credit, though, what I call the relock, is it grows over time. My access actually grows. And the way to think about this, and the simplest way to think about this, is, let me just pull this up. As time goes on, whatever interest rate is on my loan, whether or not I have a balance on my loan, my access will grow based off that interest rate. I describe it like a pie chart. If you imagine the loan as a pie chart, where my total access includes the amount I can borrow and my balance. How much I actually spend is my balance. How much I have access to is the entire pie. The entire pie is growing, not just the loan balance portion here. The entire pie grows. And so my line of credit grows if I don't have a balance or I have additional access left over. And over time, it can make a significant difference. So when we look at something like this, a $400,000 home, age 62, if the house is appreciating at 4%, that's the bar chart you're seeing right there. You're seeing that grow. The green line on the bottom would be a traditional home equity line of credit. I'm getting what I get. That is stable. It's the bank's control. I don't get a choice over it. It is what it is. The other three lines you're seeing there are just what the line of credit growth could look like over time. So in a low interest rate environment, that dark green, the orange is kind of the mid interest rate environment. And in a higher interest rate environment, like we've seen, the type of growth we can see on the line of credit. So potentially, not only do we have a buffer asset, potentially we have a hedge against a collapse in home prices when it comes to accessing the value in a home if we intend to stay in it. And so the line of credit here, because it's guaranteed, it's not bank controlled, it's guaranteed, cannot be canceled, frozen, or reduced. And because it grows and allows us to make payments to it or from it, becomes one of the most effective multi-tools we can use in retirement planning if we need to get creative in how we plan. And what I mean by that very simply is if we need to go ahead and we need to utilize assets outside of our traditional investable assets. So, I mean, there's cons to this. Let's just be right up front about it. The biggest con is interest on interest. Everybody, I hope, is familiar with the concept. If I borrow money and I don't make payments, if I borrow $100,000 this year, next year I might owe $105,000, and then my interest that I'm being charged is on a $105,000 starting balance. So reverse mortgages can be expensive if I never make payments. They also have an FHA insurance component to them, which can make them expensive as well. So there is a cost to the reverse mortgage. And Alvin was asking me this before we got started today. Hey, I've heard they're less expensive than they used to be. And one of the first things I shot back to him was, well, yes, they are less expensive than they used to be, depending on how you structure them and use them. But it's really a question of the value. You know, are they expensive relative to the alternatives that we look at? And if the alternative might be running out of money, I would say it's not expensive at all. because oftentimes that's what we're addressing with the reverse mortgage, people who are at risk of running out of money because of longevity or any of these other vulnerabilities they may face in retirement. So these are non-recourse loans, they're flexible, and they give us the ability to manage the cash flow in a way that we can't with traditional financing and borrowing options. I'd like to dive into some case studies on this. And there's some case studies that are illustrated out here. I'm going to speak to my own personal experience with some of these and some people I've worked with directly on these to illustrate them a little bit better. But the first thing we're going to talk about is long-term care needs. I imagine if I have the ability to ask all of you, well, how much money do we have here to work with for long-term care, or who's actually eligible for long-term care? There'd be a pretty big gap between who has long-term care in your book versus who does not. Most people, especially by the time they start looking at long-term care, find it incredibly expensive or unaffordable. There's also serious risk with traditional long-term care insurance, and that premiums might go up 200, 300, 400% a year, which we've seen that risk come into play over the last few years. Long-term care is, when it comes to longevity, not an if, it's a when. And oftentimes, adding long-term care into the planning strengthens relationships with our clients. So one of the easiest ways we can strengthen our relationship is make sure that we shore up this side of the financial plan. Unfortunately, if it's too expensive to utilize, or it's simply non-underwritable because of health reasons, we feel like we're stuck between a rock and a hard place. But the reverse mortgage and the housing in general can be a great solution to help afford long-term care. In two ways. Essentially, we can use it to help pay for the premium if it is expensive and it is going to impact our cash flow. The reverse mortgage can be a great way to fund the premium for long-term care if we can qualify. And if it's not, simply setting up the line of credit so I have access to a flexible, non-tax bucket of money to use for long-term care payments gives me a great opportunity. And I have clients that will actually approach me to do this. I have clients that are sophisticated, savvy people that will turn around and say, I want to set up a line of credit because I recognize by the time I'm 75, 80, I can access $600,000, $800,000 of money without paying taxes on it to cover this expense. And by the way, I had a heart attack. I can't get long-term care insurance. Or I looked at the premiums and it would cost my spouse and I thousands of dollars a month to try to afford this long-term care premium. And the benefits that I get aren't even going to cover what I need. And so why would I do that? So I've seen people literally set up lines of credit purely to create long-term care insurance. And all I want to illustrate here is the impact of an LTC event on somebody's retirement. If you look at the picture on the right, the graphic says it all. I go from having $600,000 to a dead portfolio after a 4-year long-term care need. It's a problem. If I were able to utilize something like the reverse mortgage, though, I might still have a lot of liquid assets available simply because instead of cannibalizing my investable assets, what you're often being graded on, if you will, I can utilize some of the wealth in the house to cover that expense. And I can end up in a much more secure place from a retirement perspective. So looking at long-term care as a scenario is probably one of the most obvious and apparent places to utilize a reverse mortgage and has some tremendous impact, but it's one of the most underutilized. And I think the reason why is this line of credit concept is like going into a car dealership and looking at a Corvette. They look pretty. Nobody, for the most part, looks at a Corvette and goes, oh, that sucks. But they're not very useful. Most of us don't have the utility of a Corvette doing much for us. It might be able to get us in a straight line, A to B, really fast, but it's not going to be great for the groceries. If we got a dog, it's not going to help get the dog in and out of the car to the vet. We're certainly not going to be transporting any mulch or something if we're working around the house. So while the reverse mortgage and the long-term care concept are really attractive to people, I don't know how realistic they are. I think much more tangible and much more of the SUV a lot of utility here is when I have a mortgage in retirement. And this is probably the number one place I see people utilize a reverse mortgage. It is not about increasing income. It is about eliminating an expense. If over 50% of people are entering into retirement today and they are carrying a mortgage, it oftentimes is representing their largest single expense in retirement on a monthly basis. And for many, many, many people that refinance in 2019, 2020, 21, even 22, chances are they're going to be carrying that mortgage for the rest of their lives in retirement. And it can have a massive impact on the security in our retirement. It can really harm our ability to afford a lifestyle, and it can really harm our ability to maintain a portfolio long term as we're dealing with inflation. I think amazingly, the difference it can have on a plan can't be understated. This was an actual case study placed into Money Guide Pro. This is a real life scenario placed into Money Guide Pro. We had somebody who had a 0% probability to achieve their goals to, yeah, we can achieve every goal we have set out for here simply by eliminating this mortgage payment with a reverse mortgage. And this is my expectation of advisors. I work with a lot of advisors. I'm chair of the board of the FPA Miami. I have advisory relationships from over a decade as a wholesaler in the retirement income space. My expectation is not that we tell clients a reverse mortgage is the right thing for them or not. My expectation is that we test it in a plan and we see what kind of impact it has on a plan. And if it has a beneficial impact, we put it in front of our clients as a viable option and we open up the discussion on housing wealth as a vehicle. And that discussion, again, really comes down to traditional planning was to ignore this. Today, things have changed. A lot of times it makes sense to look at integrating it. Here's what it could mean to you. And that is the simplest way you as an advisor can have that conversation. Now, I know we're getting close to the hour here. And I've got 26 slides left in this presentation. So what I'm going to do is I'm going to stop here before I go into any other case studies. In my opinion, understanding a line of credit and how it works with a reverse mortgage and the idea that this can function as a buffer asset, and understanding that the number one use I see is to eliminate mortgage payments is a great foundational start for you as advisors. When we apply that with what we know about retirement, future trends, what to expect in retirement, and some of the risk factors that are out there for women and retirees overall, I believe that you've got a really well-rounded picture of housing wealth and utility here, at least for a starting point. There's a lot more I could go into, but I'd prefer to open up the door for some questions here, Joe, if we have any.
Sure, we do. We have questions. I have one too, if it can be accommodated. Let's start off with Mariah. She asked a question. Could you please discuss the residency requirements in the HECM scenario?
Yes, that's a fantastic question. They're relatively simple. So the question is residency with the HECM. This is an FHA insured loan, which means we have to follow FHA regulations, which means it has to be our principal residence. That means we either need to live in the house or we're committing to moving into the house within 60 days of closing on the reverse mortgage. It also means that from a maturity standpoint, we never have to make a payment on the reverse mortgage as long as we are living in the house and maintaining it as our principal residence, along with staying current on taxes and insurance and maintaining the house, which might mean something as simple as playing by our HOA or COA rules. It does have to be our principal residence, however, and we do have to maintain principal residency in order for this to remain in place. If we're a married couple, at least one of us has to be able to do so.
John asked the question, does the compound interest apply to the line of credit loan?
John, it does. That's exactly that pie chart I was describing. So let's hypothetically say it's a free loan to do, which it's not. But let's say it's a free loan to do. I can access $100,000 in this line of credit. I choose not to spend any of that money. I am intentionally putting this in place to have a bucket of money as a buffer asset down the road. If my interest is compounding at 7%, well, in 10 years, I'm going to have about $200,000 available in that line of credit for me to spend however I see fit. So the compounded interest applies to both the balance and the line of credit.
Alvin has a dual question that's related. Relative to the value of the home, what percentage are we talking about in fees? I know there's different fees. And then more specifically, what are the fees? Let's see, for if I'm just getting a line of credit, what would the fees be while I'm not using it?
Yeah, so the proportional amount's going to depend. I'm here in the state of Florida. Florida is the most expensive state in the country to do a reverse mortgage. It's almost as if you're selling the house. So I would say a $300,000 house, right? If I were to sell it, I'm going to pay 6% in real estate commissions, $18,000. That's probably about the same amount that it would cost to do the reverse mortgage in the state of Florida. It would be less than most other states, but it would still be substantial, more than $10,000 in all likelihood. Those fees consist of FHA insurance. You have to pre-fund it because there's no guarantee you're making payments. That's a 2% of home value. So if I have a $500,000 home, I have a $10,000 expense just in the FHA insurance. I have my origination charges that lenders and loan officers will charge. That can vary. They're capped at $6,000. You have limits based on the value of the home. And then you have third-party costs like title insurance, appraisals, the counseling expenses, running credit, so on and so forth. They are not insubstantial, the closing costs for the reverse mortgage. However, oftentimes they can be fully financed into the loan. But for example, if I did have a $300,000 house, let's say I could access a $100,000 line of credit. I'm not planning on spending the money. I might very well have a $15,000 to $18,000 loan balance to start.
Mary asked the question, what happens when someone goes into an assisted living, and what time frame is involved before the big decision? You know, do we sell the house? Do we let the kids buy it?
Yeah, that's a great question. I'm going to speak to the reality, and then I'm going to speak to the rules around it. The reality is, if you have a single individual with a reverse mortgage, if they go into an assisted living facility, chances are they are never leaving the assisted living facility. That's the reality today. If I am not able to have at home care, chances are I am never leaving that facility. And so the reality is the house is getting liquidated sooner or later, no matter what. I think that's the reality. The rules and restrictions basically say, hey, if you are outside of your home for more than 12 months, then it is no longer your principal residence, and you have a trigger for the maturity of the loan. You now owe us everything that's due. If I'm married, however, I do have protections in place. So if one spouse ends up in a facility, it doesn't matter as long as I am still living or one spouse is still living in the house, that loan does not mature. I could also be a non-borrowing spouse and have some of that same protection in certain instances.
Related to that question from me, if the husband has lost legal capacity, has lost medical capacity, and is institutionalized permanently, can the wife secure a reverse mortgage herself and benefit from it?
Potentially, yes. You know, there's instances where you have people who are incapacitated, where they are not going to be able to be on the loan, or they don't have the capacity to get a loan in their name. If I'm married, there are potentially workarounds around that. I think one of the biggest risk factors I see today is running across people who don't have powers of attorney set up before incapacity sets in. Because if that's the case and it's a single individual, there's no opportunity to do something like a reverse mortgage. You will be incapable of doing it. The house is essentially a dead asset. If you intend to keep it and stay in the home, it might not matter. You may not have that flexibility at that point because you weren't able to get that planning done ahead of time.
Mariana, speaking for all of us, thank you very much for offering your book at the beginning. How do we receive a copy?
Yeah. Nick Tuttle has my contact information, but you're also welcome to email me directly. I don't have anybody's email or contact information. My email address is, I'm just going to jump right to the final slide here. It's jblum@mutualmortgage.com. If you'd like, you can send me an email. Just give me your name and your address, and I'll get you a copy overnighted, FedEx, and get it out to you in a couple days.
Well, this has been tremendous, Josh. I've learned so much, and every time I speak to you, I learn. So I've always complained that just having a conversation, I deserve to get a continuing ed point. But thank you so much, and thanks to Nick for putting this together for us, and the team of the Knowledge Center, and thank you all for attending. This has been hopefully very insightful for you. Thank you again.
Thanks for having me, Joe. I appreciate it. Thank you, everybody, for your time and attention.
Take care.